I bought AMD stock at under $100. And as a product manager who spent time at Tesla and now works at Microsoft, I spent my career watching how massive scale and hardware constraints actually collide in the real world. So when AMD dropped its latest earnings report and immediately crashed 9% after hours, my first reaction was pretty simple. Wall Street got this one wrong. Record revenue, data center up over 100%, earnings crushed, and guidance bumped even higher. On paper, this is a monster quarter. And this is why we built Wadoot AI, so that you can cut past the PR spin and track how the entire AI stack actually works from silicon all the way up to the customer. Because when you dig past the victory laps, you find one detail that the headlines left out. And it explains why smart money sold and what AMD now has to prove over the next 12 months. It truly was a monster quarter. AMD pulled in $11.536 billion in revenue, which was a company record and up 50% year over year. Data center revenue hit $6.7 billion, up 107%, making up 58% of total revenue. And non-GAAP earnings per share hit $1.66. Operating income cleared $3 billion, and next quarter's guide, around $13 billion. These aren't just good numbers. These are massively good numbers. Meanwhile, the broader market did hit records and Palantir popped nearly 30% on its own AI growth. So the sell-off here wasn't a massive macro panic. The real clue shows up when we compare what did AMD deliver to what the market expected. 3 months ago, AMD guided quarter two revenue to roughly $11.2 billion with a 56% non-GAAP gross margin. They delivered $11.536 billion and 56% gross margin. They beat the revenue midpoint and hit the margin guide. So why call 56% a margin miss? Against their own guidance, the reality here is markets don't trade on guidance alone. They trade on expectations. And AMD had hyped major AI rollouts. Investors weren't just pricing in a good quarter. They were pricing in acceleration. And AMD accelerated. The problem is one key financial metric that moved the wrong way. Revenue up, data center up, earnings up. But our arch nemesis, free cash flow, went down. So let's peel the onion a little bit here. Quarter one free cash flow was $2.56 billion. Quarter two free cash flow was $1.558 billion. So free cash flow margin plunged from 25% down to 14%. And at the same time, capital expenditures on property and equipment jumped from $389 million to $808 million, almost $1 billion. And this is what investors saw. 50% revenue growth, 107% data center growth, yet they converted less cash than the 3 months prior. And that breaks the easy money narrative here. The quarter was strong, but the growth didn't flow cleanly through the balance sheet. So is AMD spending heavily because its AI opportunity is exploding? Or is it because competing here is getting way more expensive than expected? Both stories fit the numbers. To figure out which one is real, we have to look at the actual segments. So CapEx more than doubled sequentially, while data center more than doubled year over year. And that doesn't guarantee a payoff, but it does change the question. If AMD is entering a massive deployment cycle, messy cash conversion is the price of building infrastructure ahead of revenue. The bull case here is that AMD is aggressively investing into visible demand. The bear case here is that AMD has to burn massive cash just to stay a distant second to NVIDIA. So let's look at where the revenue actually is coming from. Data center was $6.7 billion, up 107%. Client revenue was $3.1 billion, up 23%. The embedded business that they have was $977 million, up 19%. And gaming was at $779 million, which was a 31% decrease. AMD is no longer a gaming chip company, period. It's an AI infrastructure play. And for me, that shift is personal. I started following AMD as a gamer who was rooting for the underdog. But being an underdog is not an investment thesis. The real thesis here is that AI compute is such a massive market that it has enough to support a second place. And AMD doesn't need to destroy NVIDIA. They need to be a credible alternative so that big buyers are not locked into a one-party ecosystem. And this quarter did prove that that opportunity is real. An opportunity isn't going to just be a durable monopoly. And that's what brings us to the NVIDIA trap. Every single AMD debate turns into an NVIDIA comparison. Can AMD beat NVIDIA? And it makes a great headline, but it's the wrong test. The real question is whether AMD can capture enough deployments to be the default second for AI compute. And the reality here is big tech buyers do want alternatives so that they can have leverage in supply security and architectural flexibility. AMD's release lists deployments and partnerships with Anthropic, Meta, Microsoft, OpenAI, and Oracle from their Q2 2026 results. And those names carry real weight. But a press release isn't going to be recurring, profitable revenue. And they have to ship at scale, and their software has to perform, and the margins have to expand as the volume does as well. And this quarter did prove demand, but it did not prove the long-term economics. Let's take Kimi K3 as a live example in the Kimi organization. AMD has showcased newer Kimi models running on Instinct GPUs, including Kimi K3 Inference on MI355Xs. Microsoft Foundry lists Moonshot AI models today, and we know that Microsoft and AMD expanded their partnership around the rack scale systems that AMD offers, Helios, on Azure. So to be clear, that doesn't prove a specific Azure Kimi endpoint runs on AMD hardware today. The point is the stack. Open models need massive inference, and cloud providers want a multi-vendor option set, and AMD wants to play for the compute layer. And this is really, like I said, why I built Wadud AI, so that we can track the entire stack from the models that people are using every single day to the cloud and the silicon underneath it, so that we can figure out if these economics actually work and how to make them work for you. That's real analysis. Treating AMD as a discount NVIDIA is lazy. The risk is turning technical demos into sustained, profitable production. And AMD's Q3 guide tells us exactly why investors are torn here. Q3 guidance implies 41% year-over-year growth and another 13% bump over Q2, with gross margins holding steady around about 56%. So revenue keeps on climbing, but margins aren't expanding yet. Revenue proves demand, margin proves profitability. So if their new AI stack scales, that growth will eventually unlock better operating leverage, better margins, and stronger free cash flow. But right now, they're asking the market to fund the ramp before the leverage shows up. And that is classic execution risk. If it works, this quarter was the early innings of a massive expansion. But if it stalls, investors paid an AI multiple for low margin growth. The question for today is, did that uncertainty cause the 9% drop? Well, let's be honest about what we can actually prove. The sell-off matches a market that wanted more, a bigger beat, faster margin expansion, or cleaner cash conversion. Anyone claiming one definitive reason is genuinely guessing, and you all know that. So here's what we do know. AMD posted two conflicting stories this quarter. Number one was an operational win. Record revenue, explosive data center growth, strong forward guide, and all that good stuff. But on the other hand, there was financial friction, weaker cash conversion, higher CapEx, and flat margin guidance. Wall Street decided that the financial friction outweighed the operational win, at least for today. Does that break the long-term thesis of AMD as a company and a major AI player? No. I'm still long on AMD. And this, as you know, is not financial advice. They're competing in massive markets. And the reality is that data center builders do want multiple options. And that's a fact. It doesn't mean that we just ignore the flaws, though. And over the next few quarters, what I want to see is if these AI wins convert into sustained revenue and real cash generation, not just spending. If they do, this dip is straight noise. And if margins stay flat while spending balloons, the skeptics here were right. So why did AMD fall after a record quarter? We know for a fact it's not because the business is failing. They delivered brilliant results, but the market priced them for perfection. They proved that the demand exists, but they haven't proved how efficiently it can turn into cash at scale. Remember where we started. AMD is not being judged like a scrappy gaming underdog anymore. They're being judged as a core pillar of the AI economy. And that's a massive opportunity and a zero margin for error standard. So I'm holding. That's my call. It's not financial advice. Drop your take in the comments. Was this just an expectations reset, or did the market spot a real flaw in AMD's business model? If you want to keep cutting through the hype, linking models like Kimi and Fable directly to the data centers and the hardware underneath them, subscribe to Wadud AI. We aren't just watching the AI race from the sidelines. We're figuring out how the stack actually works before the rest of the market catches up. I'll see you on the next one. Peace.